Hello, hello, good morning, good morning. And if you are watching this recording, you can feel free to skip ahead about a minute or two to get to the content. I am going to share this out and invite a couple people. It's for some folks that asked me about this topic. So, of course, when you hop on, let me know who you are and where you're from. And while you're doing that, again, I'm going to invite some people and share this out in a few places. I got to have all of my technology going on. Y'all know how I do. And where am I? There it is. Awesome, awesome sauce. Get this shared out in a few places. Let me move my mouse here so I don't kick myself off as I have done. Hello, good morning, good morning. And then we're gonna get started. Okay, my technology is messing around. I ain't got time. Okay, well, then I'll just have to fool with that later. Y'all, I know I don't have a whole bunch of time for foolishness when it comes down to technology. So I'll deal with that later. All right. So I want to welcome you to the show. My name is Lysandra Everett. I am the Home Biz Tax Lady. I help home business owners win the tax game by helping you keep more of your money in your pocket and paying less to the IRS. So I'm answering a question today about C Corps, okay? I have someone on my list who is asking, she has a C corporation and she wants to know the tax implications. Okay, let me say this. Before you form any type of structure, it's best to have this conversation before you actually form the structure rather than after, okay? So, so if you're thinking about going into business, really, you need to build your financial team. So I will say that right up front. You need to really talk to accountants, tax professionals, attorneys, all of those types of people is what you really need to have on your team. Because the truth is, there is no one cut and dry answer for everybody. Everybody's, the different business structure is going to help and hurt differently. There's always pros and cons to everything. And so you have to find the one situation that fits you. And it's not a one size fits all for everyone. Thank you so much, you guys, for joining in. And I appreciate it if you share this out. All right, so let's talk about C Corps. What is a C corporation? All right, so a C corporation is a business entity that is separate from its owners, okay? So unlike a sole proprietorship, with a sole proprietorship, when the owner dies, the business dies. The liability does not just stop at what the company owns. It's, everybody, all of your personal assets are also included in that potential for a liability. So sole proprietorship, that's where you start, not where you stay. All right. Then, and really the progression of people when it comes down to business structure is that, listen, everybody starts at a sole proprietorship. I don't know a person that didn't, because just about everybody's business that I know of, no matter how small or how big, started at somebody's kitchen table, somebody's garage, or whatever. It starts as sole proprietorship. Then most people move up to an LLC, perhaps an S Corp, and then a C Corp. But usually there is a progression. So we want to focus on the C Corp for today. All right. So first thing, the C Corp is, let's talk about the tax part first. Okay. So one of the things that people hear about with the C Corp is this double taxation. So let's talk about what that is. So with the C Corp, the corporation itself is taxed on the profits. And then there's also potential for shareholders to be taxed at the dividend level when the profits are distributed. Okay. So that is the double taxation. Now, there are 8 tax brackets for C corporations, okay, that range anywhere from 15% up to 38%. Okay, so, and it just depends on the income. So what that means is really based on your income level. If you're at the LLC thinking about going to a C Corp or S Corp going to a C Corp, you need to look at the income level to see if you're really going to save money here. All right. This is what really is one of the biggest deciding factors, is the amount of income that you have. Now, as far as ownership, where C Corps are different from S Corps. Okay. With C Corps, you can have as many shareholders as you want, where with an S Corp, you can only have up to 100 members. Now with an S Corp, you can only have 100 US citizen members, okay, shareholders, where with a C Corp, you can have just about anybody be a shareholder in your company. Now, why does this matter real world, okay? Because everybody's up in arms about Donald Trump's taxes, right? All right, so let me explain why I believe you will never see his taxes. Because you can have foreign companies, foreign corporations can own stock in your company. So if he releases those tax returns, you're going to see exactly which foreigners has stock in his company. You're going to see who he's paying or who he owes money to in those tax returns. That's why you're not going to see those tax returns. Sorry, guys. Okay, just explaining real world how that looks. Now, if you own an S corporation, if you can only have up to 100 members. C Corp, you can have 8 million of them. All right. So if you are planning to go public, for instance, you're going to have a C corporation, because those are only companies that can go public, because you can have unlimited numbers of shareholders. Okay. So why would somebody like go through the drama of a C corporation? Okay, speaking of drama of the C corporation, one of the reasons why people shy away from C corporations is because it's paper intensive, right? Hold on a second. Let me tell you what all you got to have. You have to hold board meetings, shareholder meetings. You've got to keep minutes of the meetings. Of course, the filing, corporate taxes. So nuts and bolts is, when you are getting to the income that you are considering a C corporation, you want to make sure that you have an actual board where people can really do these things, and you can spread this work out, because really a C corporation can be labor intensive just on the paperwork side. Okay. Now, C corporations have to file their taxes by March 15th, and they file on a form 1120. What that means. All right. So I have seen, and one of my clients had this issue where she had a C corporation, but it was just her. But the tax person that she had filed her taxes on a Schedule C. No. Okay. If you have a C corporation, you must file on a form 1120, not a Schedule C. Okay. 2 totally different forms. All right. Let's see. Okay, so we already talked about the drama, the shareholder meetings and all of that stuff. That is one of the reasons why people shy away, because with an LLC and S Corp, it's really not that much labor intensive compared to the C corporation. Now, every state has a different fee for creating the C corporation. So there's no cut and dry answer there as to how much it's going to cost. So don't ask me. It really just depends on your state. And okay, tax payments. The other thing about a C corporation, if you owe, if your tax liability is $500 or more, you will be required to make quarterly estimated tax payments for your company. All right. And if you have employees, that's also in addition to your filing your employment taxes, which is monthly. Then like I said, you're talking about filing quarterly estimated taxes. So as you can see, it can be labor intensive. So if you have a C corporation, you really want to be able to outsource this to a tax professional or a CPA in order to handle all of the administrative stuff. Because, like I said, as business owners, we're trying to grow business. We're not trying to file all this paperwork. You want to be able to outsource that to someone else. Let's see. All right. So one of the key features of having a corporation, okay? So we're talking real world, right? One of the key features of a C corporation is this thing called a net operating loss. Like, people want to know, how is it that Donald Trump could go 20 years without paying taxes? Okay. It's because he has a C corporation. Now, a C corporation is able to take advantage of something called a net operating loss. A net operating loss can span over a 20-year period of time. So the first option is a carryback. So let's say that you lose money this year, right? Your company posts a loss. Well, you can go back 2 years, up to 2 years, and amend previous taxes to possibly get a refund, okay, on the taxes you filed up to 2 years previously, okay? Or if there's no carryback, if there's no, really no financial benefit for you doing a carryback, then you can carry forward the loss up to 20 years, okay? So you can carry it up until the loss is all recouped, or 20 years maximum. So when Donald Trump posted a net operating loss of almost $1 billion back in the 90s, that started his 20-year period. So it's not that Donald Trump was a tax evader, okay? He took advantage of this net operating loss. This is tax law, okay? So while everybody was all up in arms, ticked off because the rich person did not pay taxes, he did not pay taxes because he did not owe taxes, okay? And a lot of people don't know that, but he did not owe taxes because of this net operating loss. So if you take this almost $1 billion, it was 918 million, blah, 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 right? At 900 million, dude, it's almost $1 billion. So if you take that $1 billion and stretch it out over 20 years, if he could keep his profit under $46 million for 20 years, he would not owe taxes. So that is one of the things that a C corporation offers you that you don't get in other in other business structures, okay? So the net operating loss, although, in any other type of, another type of format, is distributed to the shareholders, okay? And then that loss is distributed either on a K-1, or it is used to reduce other types of income with an LLC. But for a corporation, again, with it being separate from its owners, it can, spread that loss out over a 20-year time period. The airlines, right after 9/11, when the airlines went into like a serious tailspin, airlines did the same thing. They posted these huge losses, but they spread those losses out over 20 years, and they were able to, to make money and not have to pay taxes. Good morning, everyone. Thank you so much for joining in. Okay, so when it comes down to the pros of a C corporation, okay, it's completely separate from its owners, all right? There's, again, if you plan to take your company public, you got to be a C corporation. So if you have the need for capital, you can sell shares of your company to get that influx of capital. Now, here's the other thing that you got to know. When you take a company public, right, your shareholders then begin to make decisions. So if anybody wants to know how Steve Jobs got fired from a company that he created, because you take your company public. When you take your company public, and then you might own 49% of your company where the shareholders own 51% and they vote you out, deuces. It don't matter if you created the company. What's the other guy? George Zimmerman, the Men's Warehouse, same thing, right? When you take a company public, you might be the creator, but if your shareholders own more of the company than you do, then yeah, you can get fired. If Facebook, okay, if Mark Zuckerberg does not maintain a controlling share of Facebook, and his shareholders they don't like what he does, yeah, he can get the boot. So, so when we're talking about ownership and control, people's like, woo, let's go public, okay? So, so when everybody's like, whoo, we going public, we gonna get all this money, like, yes, Jesus, the money. Okay, then you run the risk of losing control of your company. All right. So, so when we're thinking about, structures for your business, that's why I said it's an overall big picture thing. It's not a cut and dry answer. So for smaller people, when you're just getting started out in business, you might, again, start out as a sole proprietorship. You may go to an LLC. A corporation may not be the best structure starting out, but as you grow, then it may be more beneficial to you to switch over to a C corporation, because at some point it really may save you money on the self-employment tax and all of that stuff. Okay. So that's why I said, you have to have, finance professionals on your team. That's just what it is, because you need to be focused on making the money. You need to have people behind you helping you keep the money and helping you make this decision, because, getting street committee, tax advice and business advice is not a good look. Good morning to everyone. Okay, so let me make sure I have covered everything. I have my notes here. Yeah, I think that's it. Anybody got any questions while I'm looking? Yeah. I think that's all I got. I think I've gone through all of my notes. So if you got any questions about the whole C Corp thing, as to whether or not that is the best structure for you, you really need to invest the money to sit down with a professional to go over your whole thing. Okay. It's worth that, because if you become a C corporation before it's really feasible for you, it's going to cost you a lot of money. Okay. But there's always a progression. So, it's not a cut and dry answer. It's all about what your intentions are with the company, what your income is, just the whole big picture. Is not one answer. Okay. All right, you guys. So, so that's it, you guys. Like I said, if you have any questions, make sure to leave me a comment. I will definitely respond. But otherwise, that's it, you guys. Thanks so much for tuning in. I will see you tomorrow. All right. Bye.